Investing can be intimidating, especially for people who are just starting out or trying to make sense of a constantly changing market. From building the right financial habits to understanding where opportunities and risks may exist, making informed decisions is key to long-term success. I'm joined now by Brendan Caldwell, Director of Caldwell Securities Limited, to answer some common questions and concerns about investing. Brendan, thank you very much for joining me.
Thank you, Lucas. Good to be here.
So right off the bat, what is the best age to begin investing, and what should parents be doing to ensure that they set up their children for financial success in the future?
Well, that's a double-barreled one, isn't it? The best age to begin investing. Well, it's helpful to the child to be interested. So it is what I have found helpful, and I've worked with a lot of my clients, teenage children, on helping them figure out what stocks they would like, based largely on the products that they use most or they think are enthusiastic. And I ask my own kids the same question. You know, what do you like? What do you want to own a piece of? One of my daughters at one point said Sephora. So we go figure out who owns Sephora, which turns out to be LVMH, Louis Vuitton Moët Hennessy. So my daughter has shares in a cognac company, largely because of its participation in Sephora. Sold Aritzia to buy it, which is probably a bit of a mistake, but moving on. So I think it's very helpful to engage the young person at whatever age they begin to be interested, because they have an advantage old people like me don't, which is they knew what's cool and current and working and what their friends are buying, probably before some Wall Street or Bay Street analyst knows the next great thing. So whether that can be video games, and I've had a client buy into a public video game company in Poland, to one of my clients, their kids live in Mexico, or they're back and forth to Canada from Mexico. Grupo Bimbo, which is the fast food company of Mexico, and did very, very well. So once the young person's engaged, they have the benefit of knowing what we don't know as professionals and old people, and also being genuinely interested in the companies that they're owning, and investing in the stocks that they are supporting as consumers, which is probably the best way of paying for whatever it is you're buying in the first place.
And Brendan, what good habits can new investors build on to learn about the market?
The single most important thing is putting away a little bit of money every month. So you'd asked, I think, what should parents be doing to set up their children for financial success? I would suggest that they start putting a little bit of money away for their kids. In Canada, our ESP program, the Registered Education Savings Plan program, is great. God bless Jean Chrétien. He took what was a moribund RESP program that had existed previously and said, well, the government will chip in an extra 20% up to a limit, so that if you put in $1,000 for your young person, whether it could be a child or a grandchild, the government will chip in an extra $200 a year. There are maximums and different things, but it's a pretty quick way to get a 20%. And with the cost of education, whether it's university or whatever else, it's a great way of getting that set aside. But whether or not you have kids, whatever it is you're saving for, a house, the next big purchase, putting away a little bit of money just so you notice, and it could be $50 a month, $500 a month, $1,000 a month, whatever you just sort of notice, and after a while you'll stop noticing it. Now, mutual funds get a bad rap. Oh, I prefer this or I prefer that, but they're actually quite a good way, and this is frankly what they were designed for, is to take in and invest these relatively small amounts of money, and then give you the diversification and growth and the access to professional management that much larger investors can do with lump sums and segregated accounts or separate accounts. So putting a little bit of money away every month, that's the key, whatever it is you're saving for.
Brendan, I think this question is very relevant to the current situation. When we look at the news cycle as well, how can investors distinguish between short-term market noise and meaningful long-term investments?
I think you have to decide what the determining factor is. But I want to come back to my previous question and just the previous answer and just emphasize this. When you are putting aside money away every month, volatility is actually your friend. The concept of dollar cost averaging, where you're not putting all your chips, going all in on a particular week or month or market event. But if you're putting money aside regularly, when the market's up, you're buying less. When the market's down, you're buying more. You're averaging in your cost. So even if the market doesn't go anywhere, even if it just bounces around because the President of the United States has put out something new he doesn't use Twitter, it's a Truth Social.
Right.
Who puts it out on whatever, InstaChat, Snapgram. See, the kids know much more about the next trendy thing than the old people. Whatever. So because of the next social media post, the market could swing one way or the other, and it's been doing that regularly. But if you're doing monthly contributions, that's the main thing. Now, to answer your question here, I think you have to really figure out what the determining factor is. And the determining factor isn't the President of the United States and his most recent social media post. It isn't even the Iran war. It isn't trade. Though these things will come and go, they will eventually get solved. No, I think if you had to pick a single thing, it would be interest rates. Interest rates are the cost of money. They're the price of money, what you can borrow money at. And at the moment, interest rates, while they are higher than what they were for much of the 2000s and 2010s, they are still very, very low, particularly relative to the rate of inflation, whether this inflation has been driven by energy prices or the end of globalization and tariffs or whatever. Interest rates are still quite low. So as long as interest rates stay low, I think the market probably continues to run. That has been the trend that has driven markets now for, well, goodness, really since 1980, since interest rates started coming down from 20% to where they are at 2 or 3 or 4%. That has been the overall trend. And if, as and when that trend reverses, then I think the generational shift, which happens, well, every generation or two in this case, I think will change. So I think if they had to keep an eye on one single thing, it is the trend with interest rates.
Speaking about trends, what trends should investors be paying attention to over the next 12 months specifically?
Well, since I've been talking about interest rates, I'll give you my insight on that, which is that the US is not going to raise short-term rates between now and the midterm election. I am reasonably confident. A Trump appointee who's the son-in-law of a major Trump donor is now the chairman of the US Federal Reserve. I would be shocked down to my boots should they raise short-term rates in the United States between now and November. And the reason for that is the idea between rising short-term rates is to slow down the economy, to rein in inflation. But this inflation that we're experiencing right now is not demand-driven. It's not because people are buying more. It's because of this shock to do with the war, largely to do with energy prices. I say war, this whatever's going on in Iraq, Iran, and the Middle East. That's really what's pushing that up. So I'm not sure whether raising interest rates would even be an effective lever. Now, here in Canada, I think it's even less likely that they raise rates no matter what inflation does, because we are the only G7 nation that has been registering a recession. That is to say, 2 consecutive quarters of negative economic growth. Mm-hmm. That's what we have here in Canada. And you can blame the government, you can blame Trump, you can blame the fact we can't seem to get it together as a coherent nation that is working toward our collective best interests. But whatever the reason or reasons, we are having a recession here in Canada. So it is very unlikely that in the face of that, the Bank of Canada would likely raise short-term rates. So my suggestion to people particularly those taking out mortgages, because a lot of mortgages are coming due from the early 2020s, is to probably go with a floating rate mortgage. I know it's not what you asked, but that's the biggest financial decision most Canadians make. That's probably going to be a safe bet for a little while.
Last question, 20 seconds. Is it still worth investing in the stocks versus tangible assets like real estate or metals?
Well, I think the good news for young people is you probably have half a decade now where Canadian real estate's not going to go anywhere. So if you were looking to buy a condo or a house or a home or get started, I think you got a half decade to go. I think if you dollar cost average your way into the market, I think you'll be very successful at it. The nice thing about markets is they're very liquid and they can take small amounts of cash, much smaller than required to buy property or land or condos or what have you. So